Okay, so we're going to get started with the final panel of the day. Thanks for attending the event. We do have the keynote coming up after this, so stick around for that. This panel is on margin versus credit. It is about the intersection of the various models of access that FX participants use to tap into the FX market. And those have changed over the last 10, 20 years, and a lot of the people on stage now have innovated within the space in various ways. So we're here to talk about what to expect going forward and how those different options of accessing the market play out. My name is Justin Gilmore. I'm a co-founder of Shift Forex and one of your hosts today. Welcome once again. And I'd like to let everybody on the panel introduce themselves. Sanjay, if you don't mind starting out.
Sanjay Matgavkar. Is it working?
Start at the other end, and we'll fix the issue in a moment.
Okay, thank you. I think this is working. I'm K Duca, CEO, Oanda Corporation.
I'm Andy Coyne, CEO, Trana.
I'm Drew Neve, CEO, FXIC.
Kurt Vomscheit, CEO of Markets for Saxo Bank.
Sanjay Matgavkar, Head of Prime Brokerage, Citibank.
Great. So one thing that I've noticed being in the consulting side of the space and talking to a large variety of FX traders, be they individuals, small, medium-sized hedge funds, small, medium-sized brokers, is that the decision process for them around how to choose where to trade is a lot more complicated than simply price or creditworthiness of their counterparty. There's a lot of other factors that go into it. Lately, a lot of them are around technology and the ease of integration, along with regulation and being able to do everything that they need to do for their business and have reliable counterparties, reliable liquidity for doing those things. There's different models for how to access the FX market. Traditionally, it's a single counterparty model. Then it merged, or transformed rather, to a prime brokerage model. And then you see the emergence of the margin model. And there's a lot of options within those. So the first question I'd like to ask is really around how the market is structured. There's a lot of surveys out there that talk about the amount of volume that's happening and coming from various participants. So first question, I'm going to direct it at Drew and Kay and Kurt. Are FX surveys an accurate representation of the volumes that are taking place in the market? And if not, where are the volumes that are not really being seen, that are disguised by the type of participation in the market that's occurring? I'll start with you, Kurt.
Well, I think that there's a fair amount of volume in the retail space that is hidden due to internalization. I think there's a large number of brokers that what they call the traditional B-book model, where there's a lot of hidden volume. I think in terms of statistics, you can kind of look at, I think the last BIS report showed something like 8% of the overall spot volume coming out of the retail sector. But if you look at something like Leap Rate, you'll see that that's north of about 200 yards a day. And I think one of the FX brokers alone in Japan reported volumes of north of 40 yards a day, earlier this year. So I think there's a fair amount of volume that is there. But there's also a trend for these companies to go away from that B-book model more towards an A-book or an agency type model because of regulation and because of risk appetite or because of a desire for more stable earnings. So I think there's a fair amount of liquidity there that will come into the broader market over the coming year.
Yeah, I mean, there's no question that's the biggest thing. If you look at the retail businesses, I would still say 70%, 80% internalized for sure. So the numbers out there vastly understate, what it is. There is an overstatement of some of the volumes which come from jurisdictions that are unsustainable, some of which are about to implode. So maybe that goes away, but I think there is overall there's a lot more coming. Because I think just as a if you look at the trends of what's going on in swaps in the United States, what's going on in what's going to happen with MiFID II in Europe, the trends towards making this mandatory or semi-mandatory to be non-B-booked, I think is within the next 2 years is for sure going to be imposed on pretty much, most people, simply because that's where wholesale markets are going. So that's where retail markets, will go to.
Kay, any additional thoughts on that?
No, I would concur with that. I think the numbers are understated. I think, funnily enough, I think Japan's probably the closest to the truth in terms of the way they report, the retail guys report their numbers. But you have to look at other trends, and if you look at the growth in the market itself in terms of new users, and it's a 30-35% CAGR, and that's not reflected at all in the volume numbers. And so you can make a pretty safe bet that we're probably, and I would agree with Drew, anything about 50% understated globally in terms of retail flows.
Okay. Follow-up question for Sanjay and Andy. What are the banks, the non-bank liquidity providers, prime brokers, trying to do to, if anything, to capture some of this retail flow or to capture more of it? And do you think that they're being successful?
So non-bank liquidity providers, yes, I think that area has grown a lot, and I think will keep growing. There's an amazing amount of talent out there which can use, which with relatively low overhead can provide the pricing service that the price takers require. I think our prime brokerage service actually serves a lot of these clients, and we're exposed to it quite a lot. There's also quite a lot of efficiency when the buy-side providers use a prime broker client-to-client relationship, one-on-one relationship to provide some of this pricing service, which then doesn't go through the interbank service, which is of course quite cost-heavy. So I think the buy-side liquidity model is doing well, and I think will keep increasing.
Yeah. So I mean, certainly the buy-side liquidity model is an internalization model for the PBs because those are the cheapest tickets because they stay within the prime broker's environment. So that definitely has legs. There's an opportunity there for them because there's a lower cost base. I think a lot of the traditional EBs, they've always had the issue that there's always an interbank settlement on the back of any transaction. And with retail tickets, the notionals are small, therefore the spread won't really capture the cost. So there has to be solutions like Netlink that provides aggregation, reduces the throughput, and saves money. So I think those creations have come about because of the growth of retail. People are very sensitive to cost, and there's always been an effort to try and keep pushing the cost down such that people can capture more market share.
Good. Slight change of topic. Within any of the models, where does anonymity exist? How can someone who seeks anonymity achieve that and sustain that, especially as they grow? And this presumes that their strategy is something worth protecting and that they're scaling it up. And how do they maintain anonymity as they scale up? Drew, want to take a stab at that?
Yeah, I think the traditional ECN environments are very difficult to maintain anonymity. Most ECN provide identifiers. There's most of there's the traditional institutional pool of clients is so thin. Essentially, it's maybe a few thousand clients. Especially if something is unique, it's relatively easy to trace what it is, and which is why users get traced if they're toxic and banks say I don't want to price that guy anymore. There's a lot of that. I think, for example, in certain instances, anonymity is easy to maintain. So, for example, our retail clients are 100% anonymous. There's no way to know for the price providers. They have no way for them to know who the retail client is. But the quid pro quo for that is there cannot be toxic order flow that comes from, that pool. And so we cannot just put a high-frequency trading guy in the retail pool and hide him anonymously, because then the price providers will stop quoting it and will demand, identifiers. And so I think that anonymity is available to certain people very well. It is if their trading style fits, if their trading style is non-market maker friendly, anonymity is not available. It may be nominally available at first, but essentially you get called on it, like an anonymous venue gets called on it by the market makers who will say, all these tickets are no good, they're coming way too frequently, and you either isolate it somewhere else or I widen out all the thing and I'll ruin the pricing for everyone. So there is no, unfortunately, it isn't like an exchange where where it's an accepted rule that anonymity is just there's no way to trace the client. It is what it is. In FX, it's like the internet. There are no secrets, and if you behave badly, it'll catch up with you. And I think that's really a message that's tough for clients to understand, because they think they're sitting in front of their computers and no one else is around, so there's privacy. But in our market, there's no privacy.
Andy, any additional comments on that?
Yeah, I mean, I think it's well understood that there are certain people. It depends on who you are and what your end goals are. So in the institutional market, anonymity is more difficult to maintain. Therefore, that's why you build up relationships with the executing brokers. You may choose to work with the people who give you good research. And you might start using algorithms, or some of these algorithms now being developed to get your execution done in a certain way, or just have someone warehouse risk for you. But then, people in the retail space, I mean, anonymity's always been there in the institutional space through the major ECNs. But like I said, it depends on the size you're trading in, etc. In retail, it made a lot of sense because the end users were typically non-threatening to the market, in the sense that there was gaming going on, etc. That it was fairly passive, although that has started to change over the years as people start to use different algorithms, etc. And there's a little bit of everyone following each other. But I think it's well understood, and I think a lot of the liquidity providers have enough analytics and continue to develop them such that they get a feel for what's happening in the market, and they know whether there's some issue that they need to deal with. So.
Just to add to that, I think anonymity cuts both ways, right? It obviously has some benefits, but I think things have changed over the last couple of years. 2 or 3 years back, platforms would be falling all over each other to get clients at any cost. But I think that the equation's now much more balanced, balancing out the interests of both the liquidity providers and the end users, because it's getting good liquidity has become difficult, especially if liquidity providers aren't making money. And as Andy said, they've become much better at analyzing whether they are in fact making money or not. Plus, it's become a more diverse set. You don't have just bank liquidity providers who could, in a sense, rely on an inventory and a book. You now have people who are much more accountable and sharper at that analysis.
Yeah, I would echo that. I think that the key there is not necessarily to look for anonymity, but to find ways and people to work with that recognize the strength in the relationships and look to help you source liquidity from venues that suit your business model. So find somebody that can give you some flexibility to execute, either with a single bank stream or to execute on, access to anything from ECNs through to managed liquidity pools through to customized feeds. I think it's much more key to look at your quality of execution over time than to try to figure out ways to preserve your anonymity and hide your flow characteristic. I think it's a very short-term objective if that's your desire.
Question for Sanjay, and then we'll go down the line. At what point should a large FX trader, by which I mean any type of entity or business, allocate substantial resources to actively managing its own liquidity relationships as opposed to having a broker or prime broker manage them on its behalf? When does it make sense in the life cycle of a large FX trader?
So actually, we see this debate taking place quite a lot. A prime broker, of course, won't manage the execution piece of it, and when you have a prime broker, you still have to manage those execution relationships. I think if you're a large professional shop, and like we've just been talking, it's managing liquidity is something you need to be very proactive about. There's a lot of analytics, starting from a most basic post-deal analysis of the value of the flow to far more esoteric things. I think it's very important for large liquidity providers large liquidity consumers to engage the liquidity providers and invest in it. If they don't, to some of your points about whether a margin, a single point of contact margin type of structure works better, that might just be the case, in which case you're relying on your aggregator, who's your counterparty, to manage the liquidity behind it.
Yeah, I think there's definitely scale in working with, in our case, a prime of prime, to leverage not only the technology that's used to access the various liquidity venues, but also leverage the relationships with the LPs, to leverage the infrastructure in terms of the tools, in execution times, reject rates, spreads, depth of liquidity. We have teams of people that are focused on this, and it is quite a large amount of effort to ensure the best possible liquidity for given needs, and different trading styles clearly have different needs and need to be serviced differently. So I know that many of the banks that we work with, they often tell us that we're the most transparent e-client that they have, and that served us very well in terms of constructing not only the liquidity pool that we access, but also the liquidity pools that we make available to our clients.
Yeah, I'll echo that. I think most people abuse their management of liquidity. And I think that because they compared it to equities where there's no accountability, for what you did, or they simply for short-term gain purposes, it's easy, to abuse liquidity. And I think us managing it has been better. But for it to be successful, it involves a lot of trust. So if the person is, giving us only a small piece of the business, and he's doing, he's letting us manage a piece of it, but then he's managing the rest of it himself, it sort of ruins it all, and there's not much you can do for that person. And I think there is people trivialize how difficult this thing is, and how ever-changing it is. So, for example, personnel changes at a liquidity provider, market changes, all change the makeup of the liquidity pool, the tolerance, and everything else. There's a million other factors that are not related, and they're not linear, right? So, because EBS made a system change now that affected the profitability of certain market makers a certain way. There's lots of things that are, there's lots of points of information. So there is, I think, an argument to be made that, to let a professional do it, but, to trust in this business is a very difficult thing, and it's hard for clients to trust, because this is the OTC industry, FX included, has violated trust of clients so many times, in so many instances, that it's very hard for clients to trust. But rarely have I seen clients successfully do their own liquidity, usually do themselves a disservice. And usually we see clients who have very benign order flow, if they did it right, just decide for short-term reasons, to sweep the market, hit everybody at the same time, and say, oh, you see, for this trade I got done really cheap, really fast, but now you did that 5 times, and the spreads you will see for the next 6 months are much wider, so you kind of screwed yourself. And
it's very difficult to go back.
It's very difficult to go back, and it's, so the liquidity providers abuse trust, liquidity takers abuse trust, and so many times that is, very hard to do. And, you can see where there's a dynamic there that's hard, but it is one of the trickiest things to do, and I think it's still, us doing it for people is definitely still better.
Yeah. So, I agree with that. I think the key word there is trust, right? So, when you look at the layers of the market, you've got the end user that needs to be able to trust the platform provider to maintain the tight liquidity, but then the platform provider has the, really the obligation to probably spend most of their time managing those liquidity providers' relationships, just because, as Drew mentioned, when it does go wrong, or where someone's sweeping a book or working on different platforms, which we know some people do, but you can't necessarily control, that can damage the relationship between the liquidity providers and the users. So, and I've been involved in many conversations, got dragged as an ex-PB person. I was in many conversations where, as a PB, you can't really influence it because all you're doing is providing market access. So the PBs aren't necessarily involved, but nevertheless they do get pulled in, especially when it's their own liquidity provision that's being discussed, or their executing broker side of the business is being discussed. So there's continual conversations around this, and I think it comes down to relationship. To build up the trust, you can get a good relationship going. Ultimately, everyone benefits. It can work, but it's a constant effort. I mean, it never goes away.
Yeah, I would agree with that. And I mean, if the question is at what stage does it make sense? It's right from day one, because it depends really to the degree into which you engage with your liquidity providers. And so the bigger guys, we do, as an outfit, you go all the way, you're doing co-location, you're talking about PIP waivers, you're talking about time to live, and you're working very closely with your liquidity providers. And you have to do that, because if you're not doing that, you're talking about between 5 to 15% of revenue just leaving on the table. And it's equally true for our clients. And even the smallest client, they still have to talk to their outfits, talk to their brokers, and just make sure that it's all about the relationship. Technology plays a part, but it's not even whether part of it is the newbies who don't really understand what it is to be toxic, but there's also stuff like that happens. Stuff happens like spikes. And if you don't have a relationship and you're not talking, you don't understand what's possible, what's not possible, then you get this adversarial relationship. So it comes back to the point you made. It's all about trust and education and making sure that you understand what you're doing on both sides. And that starts from day one.
Good points. Is the central clearing model viable for spot FX? And if so, and this trend towards central clearing continues, who stands to lose the most during the transition, and who stands to gain? First for you, Andy.
So I think this debate's going to run actually for quite a few. Well, it's been running for a while already. So it's a great question. I think the way that I view that is there are certain people, but we know that the FX market is very dependent on settlement, or the settlement process, in particular around CLS and CLS aggregation service that we run. The important thing about that is one of the main reasons why FX has, to a large extent, particularly for spot, avoided the regulatory backdrop that's happened elsewhere. Because it seemed to be controlled, it seemed to have a very robust mechanism around settlement in the FX market, which is the main issue, right? The main risk that people can concern themselves with. Having said that, there are a lot of market participants who really don't require settlement. It's not a part of their makeup. A lot of people trade and close their positions at end of day. There may be high frequency, there may be retail. Settlement isn't the thing that they focus on, because they never need to settle. All they're doing is settling their net P&L to an account. So to those participants, it may look a bit like, well, why am I part of this infrastructure? I know that on the back of the trade I did with an executing broker, there's probably another interbank trade between the prime broker and the executing broker, and there's a cost element there because they have to settle. So there is that awareness. Can FX be cleared? Well, in theory, absolutely, right? I mean, it's another financial instrument. I think it'll probably come down to ultimately a review of costs. Whilst I think the banks are big supporters of CLS, some clients may have the choice, depending on the cost, to clear. That might kick the whole debate off.
Anyone else want to chime in on that before we go to audience questions?
Yeah, I could just add to that. The way I see it is if the question of spot moving to a cleared model. So you've got the cost angle, which is very important, and the costs on the interbank side have increased quite a lot. CLS costs are now quite significant. Plus, there's the messaging cost, which one of my good friends here doesn't mind, but it does become quite expensive. But yeah, so I think the costs over the last 18 months have increased very substantially. Prime brokers are finding a larger and larger piece of their revenues are going to, especially CLS and clearing costs, and there haven't been a commensurate sort of increase. So the natural question on the cost front becomes, what works better for the kind of client that Andy was talking about? And right now, I think they're roughly in sort of balance, but if that changes dramatically, I think then there could be a lean on either side. On the regulatory front, I don't think there's anything that I'm aware of right now, although all the regulations, especially from Europe, aren't final, and the ones in the US, there's still some definitions and still some clarifications required, but I don't see any need from the regulatory point of view. Liquidity, I think OTC liquidity is sufficient. I doubt whether there's going to be much. There's certainly no demand for liquidity. I think clients like the ECNs they have. They like their bilateral arrangements. So I don't think there's going to be much pressure from clients. So bottom line is I don't think there's going to be a move unless there's a big change in the cost equation.
Okay. Any questions from the audience? Don't be shy. All right. So let's move to something a little bit different. It's not on the list, but I'm curious to hear how you guys respond to it. A big need in the retail sector is for reliable liquidity for non-spot products, for CFDs in particular. I'll leave this open to whoever wants to respond first, but do you see any progression towards provision of reliable two-way pricing, market making in CFDs and in non-traditional instruments?
Well, I can start there if it's okay with everybody else. But we have 23,000 instruments on our platform. We've been market making CFDs for quite some time, and we most certainly see a trend for more consumers of that liquidity, not only on our platform but also via API. So I think it's very important to have a cross-product, cross-margin platform.
Yeah, I think we're, CFDs today are a big piece of our business, or even used to be before, and we stick to mostly sort of metals, energy, and index, but because we have a lot of non-bank price providers, and now we own one, which is Lucid Markets, one of the big ones. We're starting to essentially bring our no dealing desk model to those CFD instruments, and we're actually launching this summer. We're going to have we started putting metals on a month or two ago, and we're going to start with the indices and energy probably this summer to do that and have multiple non-bank price providers. The only difficult issue there is there's no PB infrastructure. There is no there's no settlement and clearing infrastructure like there is in FX. So essentially, it makes us do all of that internally, and obviously it's a lot more kind of that end of it's much more complicated. But we see that as a big growth because there's enormous need for it. So the CFD industry is sort of, I feel, sort of 5 or 6 years behind FX in terms of the toxic clients are a lot less, the sophistication of clients is less in terms of how aggressive they want to be. They're paying more for than they would in futures. It's like the equivalent instruments, if you will. And
With better leverage.
With better leverage. So they're trading essentially better leverage and, essentially much lower margin requirements. And the relationship, they're trading that for essentially higher cost, and they must be friendly towards the market maker. So what we have seen is now a need of people wanting to have the same, to be able to trade like they trade with futures, be able to be toxic, to be able to be more aggressive and have those kind of costs. At the same time, they want, kind of the leverage. So this can only be done with, with that. So, but that is a stay tuned to experiment, not yet a, work in fact. And we have a few early, pilots that have been very successful, but we have yet to do that with a few 100,000 clients like we do it in FX. So, we'll see.
Yeah, I mean, Drew mentioned, what are the drivers of growth and the fact that the CFD market seems to be a number of years behind in terms of infrastructure. So we've definitely seen a pickup in CFD PB activity. So, and a lot of it's driven by the infrastructure. So what I do notice is that whilst markets on the face of it look very different in the way that they're transacted and the people operating those markets, that in a post-trade environment, there's a lot of similarities, whether it's messaging, whether it's matching, allocations, all those things that go on. And we've certainly been part of that infrastructural growth. The CFD market is becoming more electronic, which can only be good for risk, can only be good for costs. And those sort of initiatives help the market to become more efficient, more scalable. Like e-commerce and PB tightened up the pricing in FX and made the market more available. Similar things can happen for CFDs, and I think it's starting to happen.
I think the issue is that people tend to look at CFDs XFX really as just one big lump, and that I think is lies at the heart of the problem, because not all CFDs are the same, and what we're going to see is the acceleration in the more liquid CFDs, the oil, Brent crude, German DAX, etc., far more so than some of the less liquid ones like the Hang Seng, etc. And if you make that distinction, then you see exactly the same process. Because for each of these, I have to put in place an infrastructure that is probably unique to each of them. And so if you look at it as a whole big of 23,000 instruments, etc., 90% of them, it's not worth it. It's never going to get there. But what you're going to see is the more liquid ones, the 10%, you're going to see the growth, and they're just going to become just like other FX instruments, which is exactly what we're seeing in our business also.
Yeah, we see when we talk to, we have clients that trade CFD on the cash indices, right? And we have, full systems in place for all the corporate actions. And if I compare that with, us, providing liquidity to some of the smaller retail brokers that are on, say, a meta platform, where they don't have those sort of functionalities, they're looking at CFDs on the futures rather than on the cash index, and there's not really quite the normalization there yet. So I think that sort of needs to be sorted out. Spot is spot, but a CFD is not a CFD in some cases here.
Yeah. Can I ask, I'd like to ask the panel what they think about the financial transaction tax, the impact on that market.
This is my favorite tax. So far implemented in Italy, and it excludes FX. God bless the Italians. And
implemented over the weekend.
Yeah. And it's like, it's pretty much one of the most brain-dead taxes ever been thought of by people, that to totally discourage domestic financial markets from functioning. But there is just this whole anger against high-frequency trading, like it's evil. And therefore, people don't seem to think that this is like a good thing to have a tax. So regardless of that, that for the FX business is a good is a good thing. Obviously, in Italy, it adds about $100 a million to CFDs. So, for the Italian index or Italian, CFD equities, we only do the Italian index. The Italian index just literally adds a pip to, to execution. So, you're going to see a lot less trading in that. So that's bad, but it'll drive more people to FX. So overall, I'm all for the financial transaction tax. But that's something that, luckily, is staying in Europe and not coming here. And I think the British are clever enough to realize that that's an experiment they don't want to undertake either. And I think that's, will hopefully be kept and bottled up within the, all the born-again communist countries in Europe right now. So,
But I think FX derivatives, though, are going to be taxed, if I'm not mistaken. And
FX derivatives,
from what I understand, you could be based in London, but if you're transacting with anyone within the tax zone, the FTT zone, you're subject. So it's definitely going to have a tremendous impact. Obviously, it's really bad for market participants in those countries, but also for London.
Yeah, on the wholesale side. So luckily,
on the wholesale side,
the retail customers don't do FX derivatives, and this will further keep them from doing it. And but I think that that is a however long that lasts, that is a big thing. And I think in general, it's a very positive thing for spot in general, and its financial transaction tax is one of those things that if you dovetail it with the Basel requirements and with the Dodd-Frank rules, essentially spot FX gets into this category. I use the term sort of refugee camp, be it for hedge funds, be it for corporates or whatever it is. Spot FX will become the most capital-wise and cost-wise, the most attractive place to trade and either speculate or hedge. And I think that bodes very well for our industry. We just got to get through the 2 to 3 years of turmoil that's created by rules that change every Tuesday and Thursday. But as the rules normalize, overall spot really comes out on top. And I think that's a big positive for for everybody.
So we'll end it on a positive note, at least 3 years from now. Positive note. Thanks to all of you for being on the panel. Everyone, please thank the panelists. 10 or 15 minutes, we'll have